in markets makes perfect sense through the lens of liquidity. And when liquidity trumps, it dominates, it trumps everything. Macro fundamentals, valuations, nothing matters. That was the message in any of the interventions that we've seen since 2009. And I think that's the phase we're going through right now.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with technical expert Sven Henrich. If you haven't yet watched part 1 of this discussion with Sven, in which he explains what his technical analysis says is likely to happen most now that the bulls have won the battle for control that raged in the markets at the beginning of this year, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Okay, let's get started watching part 2 of our interview with Sven Henrich. First is, we've got regular people who watch this channel and they are just trying to navigate what's going on, hopefully not become collateral damage to anything bad, and to try to at least make some money with a relatively acceptable risk-return ratio if things go well. What would sort of be some of your parting advice to those folks? I heard you say, like, all right, don't go super long into tech right now, maybe buy on a pullback, wait for a pullback to buy. If there's a pullback, if you're bearish, don't pile in immediately because that's likely to get bought in the near term. What other bits of counsel would you give them?
Well, first of all, one of the things that was missing, by the way, in May, and this had me confounded as well. Tech was already flying high, but some of my technical signal charts were max oversold, which made absolutely zero sense to me. It was really confounding. So I had, on the one hand, tech stocks just going brutally overbought and the overall market being oversold. Well, now I have the answer for that. The market's caught up. And as we approach this week now, a lot of the check boxes that were missing are now being ticked off. This market is getting now very much overbought again, which suggests, the opportunity to lighten up a bit, wait for a pullback makes sense for sure. In terms of selling, you got to be very, very careful because momentum breeds momentum, and we've seen that in the recent weeks. But there's another chart that may be worth watching in terms of a trend line. I mentioned the S&P monthly chart. We had the support holding. We got the break above the monthly 20 MA. There was a trend line that actually broke last year. It was a key resistance trend line all the way up to before COVID. And then we had this just massive blow off top, broke above it, held the support a few times, but we broke it to the downside last year as all the money printing came to an end. We just tagged that again as resistance. So as bears look like to be non-existent, having completely disappeared from the market, bulls taking over, I find that technically of interest with the lag effects still coming. I remain open to the bear case, but I'm cognizant of bulls in control. So I think this is going to be now a tactical journey here into the summer. Again, if we get a pullback into the monthly 20 MA, if it holds support, you got to respect it. Then you're probably clear for the year on the upside. However, if that breaks and would show then that this rally here was a fake out. So there's always that possibility when you get too much momentum and optimism again. If that fails, so I use measuring sticks where I know who's in control, and that to me remains a key measuring stick. I think generally volatility is way too low for the macro environment that we're facing. So I do think we're going to have another volatility spike this year. And if it breaks below the monthly 20 MA on a sustained basis, then you may actually still get a larger bear market in the second half of the year, which was originally my script. See, I'm also trying to be honest with my scripts. I'm saying, okay, well, the first half year rally makes sense to me. Second year, we'll see what's really happening with the economy, and then earnings, and then where we are. And remember, back then I said 3,200 was kind of a second half of the year possibility, which seems completely insanely impossible right now, right? No one believes that. Not even the bankers believe that anymore. Not even Mike Wilson believes that anymore. He's the most bearish guy, and he thinks maybe 3,900 could be happening, right? But that's what happens. This is the psychology of the market.
Right, it's got to break the bears, yeah.
And in October, just anecdote, which is so absolutely classic. Okay, Goldman Sachs, the crack team on Wall Street, right? Best paid guys out there. Beginning of 22, they were talking about 5,200, right? And then the S&P dropped, and then they reduced their price target to 4,900. And the S&P dropped some more, down to 4,000. I forget the exact sequence, but they kept dropping their price target. And then in September, basically right in front of the lows, they dropped their year-end price target to 3,600. And then the thing rallied up to 4,200, and they raised their price target to 4,000. Well, a week ago or two, they now raised their price target to 4,500. Now that we've crossed over 43, going into 4,400. Thanks. That's extremely helpful.
I'd love to get paid their paychecks to be able to forecast that well.
No, but it's so reflective of, when I say the environment is difficult, I'm not trying to make fun of them. I'm just trying to highlight that the biggest pros on Wall Street get it horrifically wrong, and they get jerked around, and no one has any particular insight, predictive insight in terms of how this plays out. They're all chasing price. That's why I'm saying liquidity has a lot to do with this in terms of how this is all being influenced. But we got to understand all this, where we choose individually how we view risk reward at any particular given time. And so to me, this is an adaptive journey. I mean, I don't like risk reward to the upside right now at all. Shorting is hard and dangerous for most people anyway, right? But I do see short opportunities setting up here because of having that cup and handle target being reached, trend line being reached, overbought reading sentiment, and potentially liquidity coming out. So that there are possibilities there. And then when that happens, then we need to see, again, a new battle for control. Can bulls to defend the key measuring sticks or not? And this is where then macroeconomic data comes in as the journey unfolds. This is, no one needs to be stubborn about anything. This remains a complex journey to navigate through, and then using signals to be tactically positioned.
All right. With Lance Roberts, who's a financial advisor who's endorsed by Wealthion here, he's on the channel every week with me. And at the beginning of the year, he declared this as the year of the audible. And I hear that's what you're saying a lot too, which is we just have to be really nimble and be ready to change the plan at any given moment, given the way that things are unfolding on the ground here.
Well, this market is doing a fantastic job of making everybody look like an idiot at one particular time period. I guarantee you, this is going to keep surprising us into next year as well. So we just got to be humble in terms of the developments. And I haven't even spoken geopolitical, any of that sort, But I give you one example. You talk about recessions and or slowdown not mattering. Germany's officially in a recession. Guess what? The DAX is at all-time highs. Who cares? Yeah. Have you looked at the Nikkei lately? Holy cow. I mean, through the roof on the monthly Bollinger Band, no one cares. I mean, it's astonishing, some of the price action we're seeing. In a context of the supposed greatest monetary tightening in decades, but I don't believe it, because as I mentioned earlier, we've still got all that liquidity flushing through the system. So no, it's not been cleansed at all.
Right. You keep cracking open doors that I want to keep talking about you with. We'll be here forever if I do. Let me just ask a couple of quick bullets. One is, if you could just give a quick note on your outlook for bonds right now.
Well, this is where I go back to that TNX chart. I mean, I don't have it confirmed at all. I just see a big potential weekly bull flag, which I find myself struggling with, because if the Fed is pausing or has paused already, then this shouldn't really play out. But why is it showing me that technical pattern? Because that suggests still higher rates to come. Although, if you're talking about a recession, then you would expect lower rates. So bonds are a bit of a puzzle to me. And I'm just saying, in general, the bond market is sending a very different message than the stock market. And the stock market has been ignoring the bond market at this time. And there's this wide jaw, and both can't be right. It's kind of my view. And if the
And
bond
I'm curious, I hear people say when the stock market and the bond market differ, the bond market's usually proven right because, quote unquote, that's where the smartest guys, on the street operate. Does that still hold true in a world awash in liquidity?
Well, that's the journey, the undiscovered country, right? I mean, someone has to reconcile. This is why I go back to earnings yields. You are now in a phase where you got competing forces. You never had that in the last few years, right? Because you had the Tina effect. There is an alternative. Well, guess what? There's an alternative now. A largely risk-free alternative.
Yeah.
For yield. So why am I paying, 30 times earnings on a lot of these really expensive stocks? Never mind Nvidia or Tesla or something else. By the way, this was kind of funny. I saw some tweet from someone, some random account. They have these historical accounts, and they talked about the Ponzi scheme. The guy that actually there was a guy named Ponzi, and he was in the 1920s, and we all know the phrase a Ponzi scheme. Well, there was actually a guy that this is coined after, and he was promising 50% return in 90 days, and I had to laugh because this market here has been blowing past all this. I mean, Tesla went up 46% in like 15 days. Ponzi couldn't compete with that.
They're out Ponzi.
And again, we're talking almost $1 trillion company here. I mean, it's incredible. Yeah. But by the way, just going back to this, I talked about liquidity equation in markets. I actually posted a chart of Tesla vis-a-vis bank reserves, and it's absolutely stunning, because when Tesla bottoms, bank reserves had bottom. When Tesla peaked, bank reserves had topped. The same relationship that I mentioned in markets, we can see in some of these high-flying tech stocks. So don't anyone tell me there is not a very clear relationship that's very dominating in these markets. So this is the part of the flying blind part, because I cannot tell you where this is exactly going. It should go lower on the liquidity front, but it hasn't. And the reason it hasn't in the recent months is because of these bank interventions. So this is where I go back to the illusion part. Maybe we're all being on some level completely deceived, because we're looking through it through the wrong lens, and you cannot square it with fundamentals, just with liquidity.
And I hate to ask this.
I would just to finish that point.
Yeah.
What we're seeing in markets makes perfect sense through the lens of liquidity. And when liquidity trumps, it dominates, it trumps everything. Macro fundamentals, valuations, nothing matters. That was the message in any of the interventions that we've seen since 2009. And I think that's the phase we're going through right now.
Okay. So I hate to shoehorn one other additional question in here, but the Fed has been very particular to tell us, okay, this bank interventions are not QE, right? And you could say it's a loan, it's got to get paid back and all that stuff, and therefore it's not going to enter the real economy. Clearly we're seeing the markets react as if it's QE. How is this money making its way into the financial markets here?
But by the way, they also said it wasn't QE in 2019, when they said literally not QE.
Right. Yeah.
Markets didn't care. Well, it's excess money in the system. It always finds its way into markets somehow. I mean, if you have excess cash, you can deploy it. We can argue about the precise mechanisms. There's been a lot of online discussions about, is QE even stimulative, and people disagree with it. Well, whether it is or isn't, in terms of money going into the real economy, and for years it hasn't gone in the real economy, right? Because velocity of M2 was just not there. But it makes its way into financial assets. And as you alluded to earlier in the part, well, that's just keeps widening the wealth inequality equation, which no one seems to ever care about. So maybe it's mission accomplished, and that's the plan. I think we talked about this a little bit last time as well.
We did.
The social disintegration that's taking place in front of our eyes every month. I mean, just look at political situation. The U.S. keeps getting worse and worse and worse. There's real anger out there. And yes, the concern is that if you have a tightening cycle that doesn't fix housing affordability, for example, what do you think is going to happen? If rates are higher for longer and you don't get the cleansing of the excess, the whole issue with inflation is, you I guess declare victory when the rate of change is back down to 2%, but you have absolutely no reprieve from the prices that got raised. None. Maybe you get lucky on gas prices, but if you don't see it in your rental prices and your wages haven't kept up, you're behind.
You're behind.
If you're not an asset class owner, which most people are not, I hate to say it, then you're left behind again. So how is that helpful?
And you're looking sort of with a snapshot of where we are right now, but then you take things like AI, right, which of course everyone's cheering right now, right, but that's going to dramatically disintermediate the labor force, right? And so, if you're a younger member of the younger generation, you're just looking at a series of current blows or blows you see coming in the future that are just diminishing your prospects. I mean, you get to a point where you really lose faith, in the promise. And as you said, there's definitely sort of a simmering anger here, particularly on the lower end of the socioeconomic spectrum, but also on the lower end of the demographic spectrum, where people are just increasingly feeling like this is just not fair.
Well, if AI leads to a road where it creates a bunch of new jobs, new category of jobs that didn't exist before, that's just a vast pool of opportunity. But if it leads down to a path where, a lot of other jobs just disappear, and folks that are not well versed in that arena are just losing their jobs, then yeah, it's just going to exacerbate everything. I mean, I guess, when you look at the internet when it first came online, and now AI is presented as the new internet, basically, right? We had a lot of optimism with that, and the internet proved to be a game changer for everything. But it also didn't prevent 90% drawdown and a recession in the real world, drawdown in all the later winners in the internet, i.e. the Apples, Amazons, you name it, Google. They all got hammered hard because the view that the internet was going to solve everything, it didn't solve everything, but it was a massive game changer that led to immense opportunities. Well, a lot of stuff got completely obliterated along the way. And if you look at a lot of the companies that were the initial promised land of that time, they all disappeared or got haircuts that lasted for decades. Everybody wants to presume to know who the winners will be, and you can make the case, yes, the monopolies that we have right now, they're unbeatable, right? Because they have so many resources at their disposal. But we've said that a number of times as well. Look at the mobile space, right? It was the Nokias, the BlackBerries, or even computing, Cisco, whatever. Completely new players came along on the way. So that will take time to sort out.
Mhm.
On a personal note, and I'm for freely admitted, I'm not an AI expert. I just dabbled like everybody else, on the various offerings that are out there. I mean, on Twitter, every day now you get some thread about who there's 1,000 new AI tools, and if you don't use them, you're Stone Age dinosaur or whatever. But what I find missing, and I've done a few experiments on that in things that I actually think I know things about, i.e., central banking, monetary policy, and markets. And what I found interesting is when I ask some basic questions or put out some basic prompts, these AIs give you a ton of interesting information, and they present them in a very authoritative way, meaning, yeah, that sounds pretty solid. But being a subject matter expert, I realized that a lot of the information is completely incorrect. And so I actually went back to challenge it on it and say, well, this is wrong because of this. Here's the link. This is wrong because of that. And AI came back, and you can put that in the plus side sentence. It apologized, it corrected itself, and then it agreed with me. What? Okay, how is that helpful? Because if you're not a subject matter expert in something, you're running the risk of taking information that's fed to you by AI, and you end up being completely misinformed. Now you can say, well, the AI is learning, and therefore it took my information and it updated its information. Well, I'm just one guy. What if 1,000 guys keep feeding it different information? What is truth? What is actual reality? And so I can see one key element missing in all this AI stuff at this point, and that's judgment, human judgment. That's currently lacking. Now we're early in the process, and things can change. Freely they are an exponential, and it ultimately can be great. But I also suspect at this stage it could be a great source of misinformation, which is terrible because we got an avalanche of misinformation already. So it's going to be an increasingly difficult jungle to navigate through, I suspect, in general. But no matter my initial concerns here, investors at this point, even though, can you call them investors if they're one day 0-day options chasers, are pricing in perfection for years to come.
Yeah, I think that is something that is clear, right? When you look at like NVIDIA's price to sales ratio, right? I mean, that company needs to deliver perfection for a ridiculously long period of time to merit its current multiple to sales.
Well, they have to sell a lot of chips, right? I mean, that's great, and I'm sure they will, but someone has to pay for all these.
Right.
Is there a counter ledger to this where,
right.
Okay,
and where there'll be competitors coming in, and there'll be some more price bidding and all that stuff, right?
People talk about, even Elon Musk talking about regulation and this, that, to hone things down, and this could all get scary. Well, the Chinese are not going to regulate, the Russians are not going to regulate, who knows who's all out there. We don't know who the other players are going to be, but they're all going to be players out there. And yes, and that'll lead to competition. And competition has a way of changing things on a dime. So these wild valuations we're seeing right now, okay, I don't know how long the momentum will last, but at some point there's going to be a reality. I hope for the best. But I again, it's all about risk reward at any given moment in time, and right now, to me, it's shifting.
Okay.
And we're going to have some testing ahead of us.
All right. Well, Sven, look, I have a lot of questions we didn't get to. It's always a sign of a great interview where you just kept throwing diamond after diamond here into the discussion. My last question for you for now, of course, we'll have you back on. And actually, if we get to the point where your TA shows you, I think you said, we could get to a point where, if the bull run really does begin to encounter real resistance, we begin to see a potential door opening for a real reversion. We'd love to have you come back on the channel and kind of just update us on what your TA is saying at that point. So whenever that happens, please let me know. We'll bring you back on. But back to kind of all the, there's a lot of dislocations right now, right? There's dislocations from the key moving averages. There's dislocations from the fundamentals. There's dislocations from what the Fed is telling us versus what the market's believing. I mean, it's just dislocations everywhere. A lot of that's being driven by, policy and whatnot. So if you were in charge, if I made you Emperor Sven, what are there any reforms that would be like at the top of your list that you'd want to do to start trying to bring things a little bit more into fundamental balance here?
Oh, thank God I'm not in charge.
I wouldn't want the job. I agree with you.
Are you talking about the Fed specifically, or
really anything? I mean, it could be how the market is structured, whatever, but I imagine central bank policy is probably somewhere in your mix there.
Well, one thing is, I'm not in charge. I would just urge them to stop with the non-stop speeches that they've been given. This coming week, I guess we'll have 15 Fed speakers again.
Are you kidding me? In 1 week?
Oh yeah, we've had that before as well. And let's say they're all the best intentions people in the world. I think they're shooting themselves in the foot. As a central bank, you want to have credibility with the market. And these constant proclamations that we've seen over the last few years have greatly undermined the credibility of the Federal Reserve. Everybody gets things wrong. I get that. I get things wrong. But they're not learning from that. When you give speeches at a rate 45, 50 a month, you will get things off more wrong than otherwise. You're opening yourself up to losing credibility. The Fed certainly has done that with the entire inflation fight. I mean, remember, there are people now in the Fed that says no rate hikes, no rate cuts in 23 and 24 or whatever. Or as Powell the other day, not for a couple of years. You don't know that,
right?
You have no idea what policy should be or could be based on any type of events that are coming our way. That's the same mistake that they made in 21 when they said and led the market through hundreds of speeches. They kept repeating this. There won't be any rate hikes until 2023, or Kashkari, for example, until the end of 2023. And people believed it. I keep going back to this example. December 21, they put out a Fed dot plot forecast for the Fed funds rate of less than 1% for 2022.
Mm-hmm.
And people believed that. And where are we now? We're at 5%. The end of the year, 4.8% instead of less than 1%. Well, let me throw one at you. Everybody's now blaming the bank CEOs for having mismanaged their positions, and that's why they blew up. And yes, you can blame bank CEOs,
but they just followed what the Fed was guiding them. Yeah.
Who was telling them that's not going to happen?
Yeah.
If you're a bank CEO and you actually believe the Fed and you manage your risk accordingly, no wonder things are blowing up. So then I'm looking at this and saying, well, are you, by misguiding the market because you're so insistent on doing that, are you actually becoming a source of instability? Because now they had to come in and intervene in everything again. And now maybe this is actually prolonging the inflation fight, which then ultimately may make things worse, much worse down the road. And now Powell goes up not for a couple of years, when he doesn't know, when his own team, his own Fed is already penciling rate cuts for next year. I just think that the overall process is not helpful. I think the fact that this is still resulting in ever widening wealth inequality, there's never been any acknowledgement on this on the side of the Fed. They are risking ultimately a society breaking apart. I don't want to see that. It's incredibly challenging, and there's no accountability ever for any of that. As I said, housing prices, they added what, $1.5 trillion into mortgage-backed securities during COVID, which into a supply-constrained housing market, which blew housing prices through the roof, and they have barely corrected at all. They're pricing people out of the housing market.
And I'm doing a terrible job of trying to wrap this thing up as I am, but you keep opening these great doors. So housing market, head scratcher, in the sense that it's housing prices move more slowly than financial asset prices like stocks and whatnot. We all get that. But, mortgage rates have now been very high for a good long time. We've kind of trapped people in their homes, right, where now they almost can't afford to move, right? Because they're sitting on a really low mortgage. They're going to have a big fat mortgage on the next place they go to, or fat mortgage rate. But here in the US, we have a ton of people that are sitting on these low mortgage rates for the next 30 years. In your country, if I understand correctly, mortgages, they're roughly have to be taken out every 5 years. So theoretically, every year you have about 20% of the housing stock that's re-rating. So you would expect to see home prices correcting faster in countries like yours. Is that indeed happening here?
Well, the housing market is slowed down for sure on the upper echelon, but house prices keep going up.
Okay, so you're still seeing the same dynamic we are.
But the issue is, as you mentioned, there's a lot of variable refinancing, and Bank of England is expected to raise again this week. It's gonna squeeze people out hard. So that's the concern, that they're gonna break something hard there on that front. And the UK structurally is the sickly child of Europe now, because there are effects from Brexit, and inflation is higher than anywhere else in the Eurozone. So there's definitely issues here, also with labor, right? Because as you broke out of the Eurozone, a lot of the labor supply that was here is no longer here, or it's been reduced dramatically.
And so it was the more affordable labor too, right?
Yeah, absolutely. And so I see a lot of high street shops having closed and not coming back. I don't see any demand for all this yet. That just all tells me that the hammer is still to drop in a lot of these economies. Just closing out on the Fed. So, they need to be very careful in terms of the credibility. I think once you're into a phase where the Fed has no credibility with the market, bad things can happen because no one listens to them anymore. And so then they're going to have to follow through harder. And I think we're kind of approaching this period right now. So it'll be interesting to see what the reaction is this week to 15 Fed speakers appearing vis-a-vis what their statement was last week and what maybe they intended to have happen vis-a-vis what actually did happen.
All right. Well, look, Sven, we're coming up on 2 hours here. I could easily go another 2 with you. But this has been wonderful. Thanks for giving so much of your time and your expertise to us here. For folks that have really enjoyed this, and for the very few who may not have been familiar with you before, where can they go to follow you and your work from here?
Well, my daily musings, you can find me on my Twitter handle @NorthmanTrader, where I try to post charts, sometimes some sarcastic notes, as I'm known to do.
Who, you?
Me? I can just observe the absurdity of the world, but I'm trying to keep it real at the same time. Website is Northman Trader. Also have a YouTube channel where I post Northcasts, where I try to do a few technical macro observations in video format as well.
All right, Sven, as usual, when we edit this video, we'll put up the links there on the screen and in our description to all those assets there. Folks, if you don't already follow Sven, you absolutely should. And I don't need to explain why. You've just seen it in this almost 2-hour bonanza of insight he's given us. All right, Sven, it's just been wonderful. Look, you've done a phenomenal job of really underscoring what a tough market this is for a seasoned long-term professional like you. So you can only imagine, a regular viewer of this channel who's trying to navigate on this on their own, how overwhelmed a lot of folks can feel. So I just want to thank you for really underscoring why we on this channel encourage people to work under the guidance of a professional financial advisor and just trying to navigate this stuff. I think very few people have the expertise, the time, really, but also the skill set to successfully navigate this ever-changing environment that we've just been talking about here. Folks, if you have a good one who is creating a personalized financial plan for you and then executing it for you while keeping you well informed, you should absolutely stick with them. They're rare, they're worth their weight in gold. If you don't, or you'd like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors that Wealthion endorses. To do that, just go to wealthion.com, fill out the short form there. Only takes a couple of seconds. These consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to help people like you, hopefully position prudently given all of the issues that Sven's done such a great job talking about here. And if you'd like to see Sven come back on this program again, particularly when his TA starts telling us we need to start paying attention because there might be a directional shift, please cast your vote for that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Sven, again, I just want to say it's always an honor having you on the channel. Thanks for giving us so much of your time.
It's been great. Thanks, Adam, for having me. Look forward to our next discussion as well.
All right. Thanks so much. Everyone else, thanks so much for watching.